Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. Guys, this week we're going to be talking about indicators. A lot of you guys out there have spaghetti all over the place, man. Chef Boyardee style, man. You're throwing it at the wall, and unfortunately, you can't see the wall when you're done. Well, in trading, that's a problem because it's going to cost you a lot of money. All right, so when you think about indicators, you think about Fibonacci retracement, stochastics, Bollinger Bands, COM channel index, and the myriad of literally hundreds of other indicators. I'm here to tell you most of them are unnecessary. I'm not opposed to people using one or two or maybe even three, but many of you out there, I've seen some charts that are so full of indicators and other things that you can't even see the candlesticks. So today we're going to talk about the importance of candlesticks and volume, and the unimportance of indicators, but we will talk about a few indicators that I think are important that you might want to consider. All right, so if you like these videos, please hammer that like button, click that subscribe button. All right, I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is trade the chart, not the indicator. A lot of folks are wrapped up in all these things that are perceived to help them become better traders, right? This perception that the more things they have on their chart, the better off that they'll be. And that's not always the case, right? And I'm not saying, and you'll learn this as we go through the lecture, I'm not saying that indicators are bad. I'm simply saying make sure you know where your bread is buttered. Make sure you know what the core is here. So we're going to talk about price and volume, but we're also going to talk about indicators. We're also going to look at a lot of charts. In fact, it's mostly charts today. But I want you guys to understand that indicators are okay, and it's fine to use them in trend lines, and it's okay. But when you get to the point where they dominate what you're looking at, that's a problem, okay? And another issue that I have with folks is everyone, because of their own style of trading, will tell you that this is the best. And maybe for them, it works very well. But for you, it might not. Does that make sense? If you go here, you go to some other company, you go somewhere else, they're all going to have something a little different about their approach to trading. And some people will base that on some special indicator, right? And there's lots and lots of indicators. There's hundreds of them. I mean, even to the point, and I'm not throwing anyone under the bus, I'm just making a point. Unmol was talking about the 233 period in today. Well, I can make a 237. And every time it touches the 237, I could tell you, see that, guys? Look at this 237 period moving average. I use the 50 MA on 60-minute charts. Well, someone might use a 55 and go, look at the 55. This is the indicator to have. Do you understand where I'm going with this? When you talk about moving averages, you can move them. They're malleable. Oh, I'm using a 21 instead of a 20. I'm using a 40 instead of a 50. I don't care what you use. Just be consistent with it. Use it all the time. Don't be changing it up, because I promise you, 100%, I could go on a chart and I could change the indicator to prove my point, right? I could literally move the period of the indicator, of the moving average in this case, to say, look at that, it's touching that. Do you know what I mean? So, yeah, it's a great point. Indicators are so great, that's why there's so many of them. Right? But before we get into that, this is an old one. This is old. Okay, I've already shown this one. But when will the insanity stop? When will the insanity stop? Lost $76,000 trading options, but could have lost $800,000. I almost lost $802,000 today. And I did it for $4,100 in options premiums. Whoa. Don't do that. I like how they just write, don't do that. Oh, I thought I had a brilliant foolproof strategy that the market didn't know, and I was first to discover, but I was wrong. Sound familiar? You guys ever been in that position where you're like, shh, I got you by the short hairs, you know, and then the market teaches you a lesson. Well, after hours happened and I panicked. My life flashed before me, and I had levered up $525,000 in my account, and I had also levered up my wife's account for $280,000 for a total of $800,000. This wasn't a YOLO, though. It wasn't a double my money scheme. I was thinking I could do this 52 weeks in a year, collect a 0.5% yield on $800,000 of collateral, and move to Hawaii. Not Maui, I'm sure. Okay? It didn't work out like that. And when the markets opened, I got out of the position for $76,000 of damage. Okay? Wow. Wiped out all my gains and then some. But I'm thankful to everyone who helped me on here. Reddit in this case. Okay? When my wife found out, we could have lost $800,000. Okay? Ouch. Ouch. So this person did lose $76,000, but they were exposed to the possibility, the potential of losing $800,000. That's a lot of beef, if you ask me. Okay? And I don't care what shortage it is. That's a lot of beef. But that's a lot, guys. So the point is not to hammer or harp on this particular person. The point is to show other people that there's real, genuine damage that can be done in this business if you're not smart. And it's not a ha-ha moment, okay? There's genuine damage that you can do to your life if you're not smart, okay? And we say it all the time, but it's much harder to earn this than it is to lose it. And as this person found out, they wiped out $76,000 basically overnight. Okay? So, take heed of these When Will the Insanity segments. Take heed to this advice, because you could find yourself in a precarious position that cost you a lot more than you're willing to lose or can afford to lose in this case. Okay? Perhaps, Aaron, maybe it's greed. But either way, it's something that something you have to learn from. You have to be able to control it, Sophia, right? Because once you get a good understanding, and I think, in my opinion, a healthy dose of fear is good. Not paralyzing fear, where it keeps you from, making good decisions or, taking a trade or this or that. But a healthy dose of fear and respect for the market is always a good thing. All right, what do we have here? These are indicators. This isn't even all of the indicators, but on my TradeStation platform, if I go into indicators, lists and lists and lists and lists of indicators come up. Lots and lots of them, as Rain Man would say, right? You look over on these, and most of them you've probably never heard of, right? You probably never heard of, Golden Cross or gapless bar chart. Maybe you have. Moving average gap ratio or subsession, OHLC, QQE, don't know what that is. Zigzag percentage. I mean, a lot of these I've never heard of. There's a few I have, but most of which I've never heard of. And they're increasing all the time. There's always somebody coming up with the next great thing. And like we said before, they're so great, they're so wonderful, they're so amazing that there's hundreds of them, right? There's hundreds of holy grails out there, apparently. And somebody created each and every one of these, and the person who created it clearly and obviously thought there was some value to creating this. Otherwise, they wouldn't have created it, right? So my point is, there's always somebody out there that will tell you that this or that indicator is great. But I am here to tell you that there's no one indicator that is the holy grail. There's no such thing. It doesn't exist. So I'm not trying to discourage you from using indicators. Just don't use too many and don't put too much weight into them, right? Use them as an ancillary helping tool or something like that, right? But don't use it as your main tool for success, all right? That's the way I look at it. Now, indicators are subjective, right? And usually a crutch for newer traders. They are. I mean, I remember when I started, I had the CCI, the Com Channel Index on mine. I had Bollinger Bands on mine. I had Fibonacci retracements. I mean, I did. I had about 4 indicators plus moving averages. And now I don't use any of them. I don't even use moving averages on most of my charts. Unless it's a 60 or a daily, I don't use them. So I went from using 4 indicators to none. Now, everyone's different. I know some people that use 4 or 5 indicators very successfully. So I'm not telling you you can't. I'm simply saying don't go overboard with it. Don't get out of control. Okay? Only price and volume are objective. Everything else is based off of price or volume, and therefore is subjective, because price and volume have to happen first, right? And it says down the bottom, I'm not against indicators. I'm against too many indicators, okay? 1 or 2 is fine. Price, by definition, has to lead any indicator, because you don't even have volume without price. Think about what I just said. There can't be any volume if you haven't bought anything. So the price comes first, and then the volume to buy that comes, right? So by definition, price really is king. And the volume is a big part of that price. Don't get me wrong. We talk about it all the time. Price tells us what is happening. Volume tells us how it's happening, right? With commitment or a lack thereof. You've heard that many times. But the point simply here is don't get ahead of yourself. Understand that there's a lot of subjectivity in indicators and that you have to have the price before you have the indicator, okay? So, 1 second, guys. Anyway, so just understand that indicators are okay. I'm just against having too many of them, all right? What we're really looking for, and this is, I do a lot of lectures, and there's a lot of slides in those lectures, thousands, literally thousands. Of the hundreds of lectures I've done, almost every lecture is 10 to 30 slides, so you can do the math. There are thousands of slides. This is one of the most important slides you'll see. Okay, of all the slides I've ever, it's one of the most important slides because it's teaching you in a nutshell, in one slide, what to look for, right? You're basically saying multiple concepts converging in an area is what we're after. Yes, that's what every trader in the world is after. No trader, I don't care who they are, is after just one thing. They're looking for that one thing plus a couple other things to confirm the one thing they're looking at, right? So more specifically, we're looking for discernible patterns, 3-bar plays, breakouts, buy setups, wedges, triangles, whatever. Bottoming tails, topping tails, narrow range bars, wide range bars, patterns happening at prior areas of support and resistance, retracement levels, 50%, 40 to 60%, change of color bars, balance of power is shifting from sellers to buyers, increased volume, ending versus igniting versus continuation, stock showing good liquidity, enough volume to trade it, the stock is within its average trading range, the stock is not up 3 or more bars upon entry, stock is showing I mean, this list right here is like gold. And it's not even a full complete list. But basically, we're looking for all of these things to come together. Not one of these things, but most, maybe not all, but most of these things to come together in an area. And the more of these things that do come together in an area, the more confirmation we're getting, and the more confirmation you get, the more reliable your trades are. So I've just taken 650 pages of PTS and drilled it down into one basic concept. That concept is multiple concepts coming together. The concept of multiple concepts, right? And you're right. People want to buy experience, but you can't. You can't. That's something you have to gain on your own. You can certainly learn faster by listening to experienced people, right? You can kind of cut out the garbage, but you're still going to make mistakes. You're still going to stumble over your shoelaces once in a while, and that's okay. It's part of the process. But you still need to know these things, right? After getting all of these things, then you can look to see if there is an indicator confirming what you're already seeing. And that line is so important. After you see these things, you're just using that indicator as one more level of confirmation to add to this list of lots of confirmation, right? All of these things in here are certain amount of confirmation. And then when you talk about an indicator, it's another amount of confirmation. And the goal is to get as much of that as possible, right? So, again, for the 97th time, I am not against indicators. I'm simply saying, look at everything else on this page before the indicator. Look at all of those things first. Then use the indicator as confirmation, okay? Yeah, average trading range, a big deal for me too, right? And it's on here, ATR, all right? So, less is more sometimes, okay? New traders lack confidence. That's true, as they should. Sometimes they have too much confidence, but most of them lack confidence. New traders lack knowledge. That's factually true. New traders often blindly follow the furus and gurus out there. New traders are always looking for an edge. Well, we're all always looking for an edge. And when you get it, we try to exploit it. But new traders don't know what the edge looks like. Experienced traders have the edge because they know what it looks like. Lost, confused, unsure, unclear, perplexed, disoriented, bewildered. That's what you are when you're new, and that's normal, right? So basically, new traders really don't have an idea of what they're doing. So why am I telling you this? Because you're easily impressed, right? You're easily impressionable. It's like a teenager, right? They come in thinking they know it all, but at the same time, other than listening to their parents, they're easily impressed upon. I mean, think about it for a moment, all right? And we can relate this back to trading, We all do it. And I'm guilty of the same thing. You go to college or high school and your professor says something. Most kids, not all, certainly, but most, take that as a de facto statement of truth. Am I wrong? You go listen to a college professor as a PhD, and you're like, okay. Same. Now, how do I relate this back to trading? I come on here and talk, and you go, okay, he must be right. Someone else comes on and talks. Oh, they must be right. Okay? So where I'm going with is, you are easily impressionable, right? Which also means you are easily, begins with an M and ends with a D. What's the word I'm looking for? You're also easily, what? Let me get a drink while you guys think about that. Ding, 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 ding. Manipulated. Correct. You are easily manipulated. Now, I'm not saying this is always a bad idea, because manipulated has a very negative connotation, and it's not always bad, right? Sometimes you can be manipulated in a good way, in a positive way, but it generally has a negative connotation to it, right? So my point I'm saying to you guys is, despite everything you're going to hear, and a lot of it, most of it is truthful, you still have to, as Sophia said, go out and put the rubber to the road, right? Walk the walk. Go out and take some trades, okay? But what I want you guys to consider as you're out there taking those trades, try to discern truth from fiction with regard to indicators, because we go back for a second. There are tons of them, tons and tons and tons and tons of them. And they probably work for some people. So for that person, there might be truth in the alligator. That's an actual indicator. It's called alligator, okay? But for you, it may not apply quite as well. So if you stick with these as your base, as your foundation, right? If you stick with discernible patterns, if you stick with bottoming tails, topping tails, retracement levels, relative strength, relative weakness, average strength, these things are empirical, right? It's not something that's, I guess subjective, right? It's objective. It has a bottoming tail or it doesn't. It has relative strength or it doesn't. It is in its average trading range or it's not, right? These things are objectifiable or objectable, whatever you want to call it, okay? Then you go and look at something like this, and again, to be honest and to be clear, there are some people out there that this makes total sense to, that this is just normal, and this is helpful to some people. But I think for most people, there's a lot going on here. I mean, there is a lot going on here, right? I mean, how many of these Fibonacci lines do we have? How many trend lines do we have? We have moving averages in here. We have stochastics at the bottom, open interest vol. I mean, there's just a lot going on here. Now, like I said, to somebody out there, the person who trades this chart every day, this is perfectly normal to them. But what I'm trying to tell you, especially to the newer traders, is you don't need all of this stuff. You can be just as accurate with a quarter of this or a tenth of this on your chart, okay? And trust me, we're going to find that out here soon, all right? I'm not just putting this up here to dog on this chart. Like I said, I'm sure there's somebody out there that uses this effectively. But I'm saying you don't need all this stuff, okay? You don't need all this stuff. Let's take a look at this, okay? Those are rookie numbers. You got to get those numbers up. Oh, it's good scene. Okay, this chart lacks volume profile. There it is. All right, so focus on the chart. What you're looking at here is price and volume and one indicator, which is a moving average. Okay, it's a much cleaner chart. But what we're doing now is we're putting multiple concepts together. All right, in this particular case, the multiple concepts we're putting together are price and volume, but then we're looking at higher time frame, lower time frame. Then we're looking at topping tails, change of color bars, narrow body bars, climactic moves, the distance from the moving average. Like we're starting, note as I'm talking, we're starting to add our checklist. Check, 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 check. And nothing on that checklist is adding an indicator. There's enough on this chart for me to discern whether or not I should or shouldn't take this trade. Okay? Right? There's enough on this chart without needing 27 indicators called alligator to discern whether or not I should take this trade. Right? So we have multiple time frames. The daily is extended and far from the moving average. That's good. We also have wide range bars with volume spikes, okay, which is good because we're starting to see an ending move because we're up so many bars in a row. My job, my goal is to now, when I see this red bar here, is to drill down, okay, and find something valuable on a lower time frame chart. Hopefully, we will be able to do that. It's not always the case. There's times when stocks just open and run, and there's not a lot you can do about it. But in this case, this stock didn't do that. It opened, it ran up, which was great. It was really good because, well, we look at the daily and it's up 6-7 bars, and all of a sudden what happens? It gets really far from the moving average. We have multiple super wide range bars, especially for a 2-minute chart. Note the volume increase, especially as we get close to the top here, right here, and then topping tails come in. Then a doji bar comes in. All of a sudden, we're going from pure strength to sellers being able to impact the buyers, right? The sellers had almost no impact on this move up. 1, 2, 3, 4, 5, 6 bars in a row. There was just buyers, 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 buyers. Then you have a doji bar. Well, that means there's a battle happening, a tug of war between buyers and sellers. Then what do we get? Right after this doji bar, right after it, we actually had a green bar. This topping tail represents a green bar. The problem is it didn't hold. It didn't stay green. So what does that also show us? After a tug of war happened, the buyers looked as if they were going to continue their control, but they failed. So this is the second confirmation of weakness. The first one is, hey, we have a doji bar here, a tug of war going on very far from the moving average on a volume spike after multiple bars up on a daily chart that's super extended. My goodness, check, 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 check. But then this wide range green bar, which is the topping tail bar, was not able to hold the high of the day, right? The buyers failed to hold the high of the day. The sellers came in. This is confirming the weakness. You're going to short it at 66.50, put your stop above, and your first target's going to be the moving average. Done. It's classic. It's perfection, really, because you look at the daily and you look at this. You probably could have shorted this without the daily being this strong, right? Without the daily being this extended. But the daily just gives you one more layer of confirmation, right? And that's what we're after all the time, all right? Same here. I don't have anything on my lower time frame. My daily, I have a 50 and a 200 here, right? And you look at it and we're in an uptrend. We're above the 50. We're above the 200. The stock has a 3-day pullback and it's gapping just above that area. Well, my goal is to find an entry on this buy setup. Yeah, it's a little far from the moving average, but I'm not marrying the stock. I'm not swing trading the stock. So you look at it, there's the first buy setup entry right there. Then it pulls back and gives you an opportunity to add, right? Or if you missed the first trade, an opportunity to get in at 52. So we got in at 52. There's the call, 52 by 51.30, right? And made a couple grand on the play, and that's it. You're done. Walk away. Higher time frame, lower time frame, bottoming tail, change of color bar, consecutive lower highs on this, a nice sequential pullback on this, and then you get another retest over here, and you're like, all right, done. But note, there's not 97 different indicators here. It's pretty straightforward. Again, I want to continue to reiterate, I'm not saying if you want to add an indicator, you can't do it. You can. But I want your eyes focused on the red and green candlesticks because that's really where they should be focused. And then after that, I want you focused on the red and green volume at the bottom. And once you do that, then you can start looking at other things like the 50 MA or the 200 or a trend line or things of this nature, right? So just keep that in mind. Here's another example. This one, a little bit tougher, but I still made it work. This is a stock back when marijuana stocks were, well, actually, no, this is not when they were popular because this thing was $7 at the time, right? But you start with the daily chart. It has a little kind of a failed pseudo breakout, and it really was expected because the stock was up a lot. It pulls back 1, 2, 3, 4, 5 days in a row, and then it gaps up, right? So I know it turned red later, and we can see that later on, but at the time, this stock was what? Take a look. Hold on. At the time, the stock was in an area of support, right? So we had support down here, right, from this pivot. This stock gapped up, And now I'm saying, hey, there's a possible buy setup back above $8 or $9, possibly. I'm not marrying it. I'm just looking for a lower time frame entry. So the stock gaps up, pulls back. You get this first bottoming tail, pops, and then you get the shake. The shake is your confirmation of strength. As soon as you see that shake, you're buying it above this area, right? The first one, okay, that's tough. Possible, maybe, but tough. The second one confirms the strength, and I'm not necessarily buying the bottoming tail here, and it did happen quickly. I'll wait for it to pop up to this area 769 to stop 749, boom. Now we just squeezed the target out of this by 5 or 10 cents, but still made 2,600 bucks on it, and there it is, 770 by 749. All right, and then it eventually failed later on, but note, even back over here at 1040, it bounced back up. Right? So again, multiple time frames in alignment. All right? It is. People work hard for that, Aaron, right? Here's another one. So again, this daily is in an uptrend, and that's important to note. Now, we can also note that the 50 and the 200 are moving away from each other, right? That's range expansion, and eventually we're going to have too much range expansion where it's going to be hard to buy this. But here we get a gap over a red bar and over this $40 area. Okay? Over the topping tail as well. Not looking to marry it. It's kind of a pseudo daily 3-bar play. I really don't know if I would call that a daily 3-bar play. That might be a little generous on my part. I don't think I would call that a 3-bar play, but nonetheless. Then over here, this is a little more aggressive because it's on a 1-minute chart, right? This is pretty aggressive, again, because of the 1-minute chart. But note, faves, NVIDIA, XPEV, KMX, and Halliburton, okay, over 40. Then 631, I'm like, how? 40 by 39.60. Then how target is 40.60, blah, 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 blah. So I liked it in the pre-market, right? I liked it already in the pre-market. This was an aggressive trade. It was, all right? But it paid out, and we made 2,500 bucks on it, okay? How do you start this stuff? Pretty easy, guys. Right out of the textbook. You start with your pre-market scans. I don't have any indicators when I'm scanning either, right? So I'm looking at dollar gainers, dollar losers, right? You can look at daily gainers, percentage. I don't like to use percentage. I like to use dollar. But here's NVIDIA, for example, the fourth one on the list on this particular day. And NVIDIA is gapping over this area here. So note, the 60-minute was a little bit extended right here. But then you had 2 resting days. So the extension is not important anymore because it had 2 full days to rest. Ran the marathon, couple rest days, now it gaps up to 40, 470, 405. Now, I want to be clear about this because I've been getting some emails lately. See that little dot you see right there? That little dot. The reason this dot exists is because my 60-minute charts start at 9 a.m. They don't start at 9:30, they start at 9 a.m. So when I'm scanning at 9 a.m., there's a little dot on the 60-minute chart, so I don't have to visualize where it's gapping to. It actually just shows me with the dot. Now, granted, before 9 a.m., it's not there. But after 9 a.m., you get a little dot. Now, personally, I scan mostly before 9 a.m., but I will recheck them after 9 a.m. So it just puts a little dot there, that's all, to help some people out who struggle with the visualization part of it. But the point simply is, I'm just going down this list, and I'm looking at stocks that have decent volume and decent gaps. And this is the case here. Do I know what will happen to this later? I don't know, but it's going to be on my list, right? It's going to be on my list because the gap it has is nice. So we'll move along, and oh my gosh, right? This is what we just saw on a 60-minute chart, right? See this clean, clear uptrend on NVIDIA. See the 2 resting days. See those little doji days right there? I apologize if it's kind of small. I apologize. But see those 2 doji days? We gapped up above it. I just showed you the 60-minute chart, and I just showed you where I found it. I found it on the dollar gainers scan. It was the 4th stock on the list. It was the 4th stock on the list. And I told you guys, I scanned the 60 and the daily. And if the 60 and the daily look good, then I will go down to 5 and 15-minute charts to see what they look like there. But if they don't look good on the 60 or the daily, I don't even bother looking at the 5 and the 15. That's my approach, okay? So then you have what? A pre-market chart that's a juice box, as Aaron says right there. From 8 a.m. to 9:30, this thing's in a tight range at 475. And clean, clear pattern, you buy it at 475. And in 10 minutes, you're done. It's gone up $10. So basically, by the time 9:45 or 9:40 comes around, you're done for the day. Now, granted, it ultimately went up by like $25 or $20, whatever. But this all started with dollar gainers and dollar losers going through that list on the 60-minute and the daily, and then drilling down. That's it. Very simple. No fluff, just candlesticks, right? I'm just looking for that uptrend, all right? There's a 200 period moving average on here, but that's it. There's nothing else on here. So when I look back at that blue chart that I showed you a long time ago with all those indicators, I ask myself, why? Why do people put so much stuff on their charts? For me, it just seems unnecessary. Get to the core crux of the issue. Here's a 60-minute chart on the right. Okay, I apologize for not putting the 60 on there, but here's a 60-minute chart on the right. Got really extended, right? It went from like 152 all the way up to like 167. And then it just tanked, like climactic style tanked, right? 167 down to like 143. Chops and chops and chops. And what's it building as it chops? It's building an ascending triangle. It's got higher lows for the most part, right? And we can kind of show you that here by doing this, right? Pretty much got higher lows, okay? And a flat top. I look at that and I'm like, well, geesh. When I get to the 154, 155 area, I need to be looking for an entry, okay? But it won't happen if you don't have it on the 60-minute chart already. So I go down and drill down to a lower time frame, in this case what looks to be like a 1-minute chart, and there's a beautiful 1-minute consolidation here. Bottoming tail, looks like a 3-bar play, then a 4-bar play, then another shake, bottoming tail, another bottom. You're in at 154. You could even add a 154.45. Give it low of the day, maybe give it a little more room. It's up to you. Moves up, pulls back, moves up, and this stock ultimately gives a $2 or $3 move. All possible because of the 60-minute chart. And the only thing you're really seeing on here is a 50 MA. Actually, this is a 20 MA on this chart right here. It's a 20 MA. All right. Yeah, exactly. You just have to look at the core, right? Go to the fundamental area. I hate using the word fundamentals when I talk about technicals, but the fundamentals of technicals, if that makes sense. Okay? Same here, right? You're looking at a stock that was in a downtrend. Again, take a look because this is important to do this stuff. If you had your trend line, note, whoopsie, hold on one second. Here we go. I'm doing this because I'm not opposed to using some form of an indicator. There's your trend line, right? There's your trend line. Well, it slightly breaks above it here, then gaps above it here, but really the 130 area gives me the void to the 132 that I'm looking for, right? So again, it breaks above that downtrend line, breaks this pivot at 128, and breaks this pivot at 130. It's above both moving averages. So I'm thinking, well, if this stock gives me a pattern at 130, I'm going to be in it. But it might not, right? It may not, give that. But if it does, I'm going to be in it. All right? Why did that do that? So my point simply is start with a higher time frame, drill down to the lower time frame, okay? And in this case, you get a green bar, chop, 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 bottoming tail, confirmation of strength, comes right back up, gives you what? A little 4-bar play right there after that bottoming tail. And again, 130 is the line in the sand for me. It's right at 130. It's just above it. I mean, it doesn't get any better than this. And look at the relative strength it has to the market. It's got incredibly good relative strength to the market. And this thing just rips. Higher time frame void, relative strength, lower time frame pattern. Again, not a lot of indicators, right? You see a 200 and a 50 here, and then I just drew a trend line on it. That's it. Again, gapping over a red bar and over a topping tail. Not a ton of room here, not a ton of room, but gives you the pattern at 182, moves up, pulls back a little, and continues higher. Look at the SPY at the same time. Market's moving up, you're gapping over a red bar, over a topping tail bar. You engulfed a red bar over here on the 1-minute chart. You're getting a little 3-4 bar play, pseudo, and then it rips. So now, take a look at this. Now I'm going to change gears for a second. Okay? I'm going to change gears for a second. I just got done telling you guys you don't need indicators, and you generally don't. But changing gears means there are some indicators that are important. We look at trend lines. I think they're very important. 200 period moving averages on daily charts and 60-minute charts, I think are very important. Okay, especially when they coincide with price. So here's an example of a stock that has been holding this 1250 area, give or take, and the 200 MA is just above you. This is going to be a very challenging trade long until it breaks the resistance point and breaks the MA. So what's my point? My point is this stock was up 1, 2, 3, 4, 5 bars in a row, gave you a little doji topping tail, again below the 200 and right at resistance. You may have been able to scalp short this. Would it have been a little aggressive? Perhaps, but you may have been able to scalp short it. But you're not going long until you get above both this pink or red line I have and then this red 200, right? This is a big boy indicator. Okay, this is one a lot of people look at. Hedge funds look at, HFTs look at. 200 MA is, again, an important indicator. If it breaks, it should rip. It should, especially after all this time spent at 12 to 1250. Okay? But my point is I just got done telling you guys, oh, don't worry about indicators. I don't really, except when I'm looking on the 60 or the daily and there's a 200 there or maybe a 50 there. That's the exception for me. Now, some people might have other exceptions, but for me, that's my exception. The 200 on the daily and the 60 and maybe the 50 on the daily and the 60. Okay, otherwise, go back at it. And then, boom, what happens? Stock gaps up into resistance, into the MA, and gets spanked. Now, let's be clear. Would I have expected this stock to get spanked that badly? No. I mean, it's like a $2 pullback. I would have expected it to smack its head up there and then just have a red day. Not this type of red day, okay? But I would have expected this to struggle in this area. And it did. So when you look at that gap up, you have to be mindful. Remember, PTS, where it's gapping from and where it's gapping to. Both. Not just one or the other, where it's gapping from and where it's gapping to. In this case, where it was gapping from was actually pretty good. It was taking out 3 or 4 red bars. But where it was gapping to, that's a problem. That's a problem. Okay? Another example. This is a nice daily chart that gaps up over a little bottoming tail and over a red bar right here. And you can see right here. See that little line there? That red line I'm drawing right there? Okay? It's great. That's the area of interest for me, okay? That's the area of interest. So when this stock gets over that red line, that's my buy point. So we take the stock, it gaps up, pulls back, and bounces. Note, the pullback and bounce is the bottoming tail. You see the bottoming tail? That's immediately gapping up, and it pulls back and bounces. That's what forms and creates the bottoming tail. Pulls back, you can look at it at 27. Bounces again, you can look at it at 27 again. Okay, putting in higher highs and higher lows. And you take a look at this. We'll just use this. And look at that. That's beautiful. I mean, for those of you that draw trend lines, I mean, that's a no-brainer buy spot, right? That's a no-brainer buy area here and here. Okay, the best part of it is it coincides with exactly where you want to buy it on the daily. Right? It coincides with exactly where you're looking to buy it on the daily, and it happens to give you a great entry on the 2-minute. And you could have even added a 27.50. Okay? But where did it stop? Right at the 200 MA. That was it. 200 MA right there, the red line right there. That 28.10, 20, I think it's 28.20 or something like that. That's your target area. You get in at 27, great. It's a great entry. But just know that 28 is going to be a problem. I know the chart has a lot of void here. But that moving average is going to be a problem. And it reached its average trading range. Oh, you're saying the same thing. Exactly. Right? That's the whole point. Multiple concepts coming together. Stock is putting in an average trading range. Stock is at or near the 200 period moving average. Don't get greedy. If you're up at 28 and you're still holding this bad boy, granted that's like a 5-to-1 move, which is sweet. Walk away. Take your money. Don't be greedy. The odds after such a move that this significantly breaks the 200 are very slim, very slim. Your ego doesn't need that trouble. Take the money. Walk away. All right? I don't care if it goes to $30. You should never question yourself in hindsight. I want to repeat that for a lot of you hindsight FOMO traders out there. When you look at this chart and you see 28, 25, 200 period moving average, when you look at this chart and you see the average trading range has been met or exceeded, and you got 3-to-1 or whatever you got out of it, and you walked away, properly walked away, there should be zero regrets if this thing went to $38. You're not Nostradamus. You don't have a crystal ball. You're playing the odds. You took the trade based off of odds, and you will exit the trade based off of odds. Get your ego and stuff it back in the closet. So yes, once in a while, the stocks will do something unexpected, and they'll go up to $30. And they will. It'll happen once in a while. But you're playing the odds. You're playing what happens most of the time, not what happens a fraction of the time. Take your money, smile, and thank the trading gods, and come back tomorrow and do it again. Don't question it. If you got out for no reason, that's different. But we're getting out for a reason in a reasonable area. Don't question yourself. Okay? So, why so many indicators? Because somebody's got to make money on something, I suppose. But they're subjective, and they're usually a crutch for newer traders. Okay? Price and volume are objective. Continue to use them, right? Price, by definition, has to lead any indicator. And as I've said 100 times, I'm not against them. I'm against too many. Because to me, too many is a distraction. And you don't really want to be distracted. You want to be focused on what's really most important. And that's those red and green candlesticks with volume included. Because they're the foundation of everything that you do as a trader. Okay? And this last slide, which again is a duplicate from the slide earlier, take a picture of it. It's that important. If you start doing this and then adding decent management to it, it's going to be hard to lose as a trader. If you start doing this, finding discernible patterns, picking indicators that help, meaning I don't mean indicators like moving averages, I mean bottoming tails, topping tails, support, resistance, retracement levels, volume, ending, igniting, etc., average trading range, relative strength, relative weakness, wide range, narrow range bars. You start putting all these together when you take a trade. It's going to be hard to lose. Add in a little sprinkle of good management, and you're a winning trader. You're going to have those errand P&Ls sooner than you think. But it's going to take you time and effort, because even though you're reading this on paper, to take it from the paper and put it into your head, and then put it into your head well enough that you can make proper decisions in real time without hesitating and making mistakes, that's the leap. Right? So to take it from the paper to your brain is one thing. It's step one. And then the second level, third level, is executing on it without hesitation. And that's going to take you some time. That's where the experience comes in that Sophie was referring to earlier. And that's where people like Aaron do so well, because he spends 30 minutes to an hour every single day reconfirming, reaffirming these things. And that's what you need to do. Trust me, when you do it, you'll get to a point where you look at a chart and it just becomes so clear so fast. Right? I mean, literally, you ask Unmol about a chart. In half of a second, he can give you an answer. You know, it's like, boom, it just, Neo in the Matrix. It just makes sense. You'll get to that point. But then the next point after the quick recognition is the quick response to it. Does that make sense? The quick execution of it. All right? And I don't mean that on 100% of your charts. We all have times where we look at a chart and go, oh, man, that's tough, but it's good. And then you go back and forth a little bit. You really want to take the trades that jump off the page, jump off the screen, and go, that's the one. You know what I mean? That's what it takes, Aaron, to be successful in anything, right? When you say, I study the shit out of it, I practice, I work hard. Tell me, I'm sure you can come up with one example, but tell me a person who's really, truly outstanding at something. that doesn't put the time and effort into it. You know, it's that Kobe Bryant story. All right, young kid, show up at 4 o'clock and we'll practice together. Kid shows up at 4 p.m. Next day, he asks Kobe, where were you? Kobe's like, I'm at 4 a.m. What? That's the difference. That's the difference, right? Live, eat, sleep, and breathe it. Jeff Yates says it frequently. I don't know whose quote it is. Do what others won't do today so you can do what they can't do tomorrow. Think about that for a second. Do what others are not willing to do now so later on you can do what they can't do. So that means put in the time and the effort, and later on it's going to pay you back tenfold in freedom and flexibility. All right? And that's one of the biggest proponents of this business. See, everyone thinks this business, it's the money they're after. It's not. It is, don't get me wrong, but it's the freedom and flexibility. Let's look at it this way. Let's say, and I don't mean this negatively, I mean this positively. Let's say all you ever did was replace your current salary. Let's say you're not happy with your current salary. Let's say you make 50 grand a year and you're not happy about it. And let's say all you ever did was replace the 50 grand a year, but you did it as a trader. Would you rather make the 50 grand a year in 2 hours a day or 8 to 10 hours a day? Do you see where I'm going with it? So even if you don't blow your expectations out of the water and make gazillions of dollars, if you can even replace what you're currently making, you're doing it in so much less time with so much more freedom, no boss, and from just about anywhere in the world. And trust me, if you get to that point, you'll break through that area too. So, back to the point, focus on what's really important. Study it, learn it, okay? Don't be lazy, be disciplined. And eventually the discipline will turn into habit, okay? It will be challenging at first because you're going to have to force yourself to do it on days you don't want to. But eventually it'll become habit forming. And as the progress and success starts to happen, and you see the progress and you feel the success, it becomes much easier. But it's that first year where you keep getting slapped around that you need that discipline. Because it's so much easier to just give up because you're like, oh, I'm not where I want to be. Nobody is in their first year. Very few people are. All right? They're the exceptions, not the rules. Just understand that and you'll be okay. All right? So, I hope that you guys learned a little bit about how important price and volume are, how unimportant most indicators are. There are a couple, like we talked about, trend lines, 200 period, 50 period moving averages on higher time frames that can be very useful and helpful. And again, there are other indicators that are helpful. Just don't spaghetti-ize your chart with them. All right? This isn't Chef Boyardee. This is trading. So focus on what's most important. Keep it basic. Keep it simple, because that's all you really need to succeed in this business. So again, hope you guys learned a lot from that. I'm Jared Wesley of Live Traders. We'll get back at it again next week.